Joining us now here at Post 9, Prosperity Bancshares Senior Chairman and CEO, David Zalman. David, good to have you here.
Thank you, David.
Silicon Valley Bank lost $42 billion in 4 hours, and some would say things will never quite be the same. How have you navigated this turmoil that has taken place since that occurred?
Well, you're right. First, let me say I think banks are very strong overall. There's no question. In the past, when you had a bank stress, it was primarily because of a credit issue. This is not really a credit issue. It's a confidence issue. I mean, as you mentioned, you had SVB go under, you had Signature Bank go under, Republic, and, now let me just go a little bit back farther. For 100 years, banks have really taken in deposits, and with those deposits, they made loans, and the money they didn't have in loans, they would put into securities, U.S. Treasuries or agencies, and they would usually do it around a duration of about 3 years. The reason I say duration is because usually some people would say life. This is the repricing of them. So as interest rates go up 300 basis points or so, that duration extends to 4 years. So there's times in the market that you'll have, well, when interest rates were zero, a lot of these same banks had big gains in their portfolios. As interest rates went up 500 basis points, which I don't think was in anybody's model, you have losses in these. But over time, those will, in 1 year you'll make more money, 2 years you'll make more money, and in 3 years you'll make more money. So it's just a timing issue, and it's something that all banks will just have to work through.
But it's also, as you say, a confidence issue, and to the extent that people are looking at those balance sheets, looking at unrealized losses that may never be realized, to your point, it may not matter if you lose confidence. What needs to be done further to sort of instill that confidence at this point, or do you feel as though things are okay?
No, I don't. I think that it truly is a confidence issue. And let me point out that when interest rates were zero, we had over $1 billion gain in our portfolio. Nobody brought that up. As you come down, as interest rates go up, you might have that much of a loss. In our case, it's still okay, because if you took our whole loss off, we'd still have about 7% capital, which is about 5% is well capitalized under the FDIC. So we're in good shape. But I do think there has to be a change. If you remember last time that we had the bank stress, and the FDIC director had the ability at that time, which he doesn't have the ability at this time. They passed a program called the TAG program, which is just a transactional guarantee. And when they did that, probably within one day, things calmed down, because people didn't have to worry about the deposits in their bank, and you didn't have the shorting. I mean, today you have these people shorting the bank, and even if they make 20%, if it goes down, they make a whole lot of money. If it goes down completely, they make a whole lot of money, and so they scare the depositors. They see the bank stock going down, they take deposits out, and it really becomes a liquidity issue. And so I do think that I'm trying to talk with the Fed and the FDIC, and whether they listen or not, I don't know. I think there should be some kind of temporary deal. I mean, having this go on at the same time that you have a budget issue or a debt ceiling issue, it's not good to have both of these going on at the same time, I can assure you.